236%. That's where the Warren Buffett indicator is sitting right now. And if that number doesn't mean anything to you yet, it will by the end of this video. Here's some context. Before the Nasdaq crashed in 2000 and wiped out trillions of dollars, the indicator peaked at around 145%. Before the housing crisis of 2008, it peaked at around 110%. Today, it's at 236%. That's not just a new record. That's nearly double the peak of the dot-com bubble. Warren Buffett himself said that anything above 200% is, and I'm quoting him directly, playing with fire. We are currently at 236%. Now I want to be clear about something before we go any further. This video is not a prediction. Nobody knows exactly when the music stops. What I do know is that ignoring a signal like this is exactly how people lose everything, and I don't want that to be you. So today we're going to answer two questions. How do you protect your money if the market drops? And how do you keep making money if it keeps going up? Let's get into it. Before we get into the numbers, I want to tell you about the smartest man who ever lost everything in the stock market. His name was Isaac Newton. Yes, that Isaac Newton. The man who figured out gravity. The man who invented calculus. One of the greatest minds in the history of science. In 1720, Newton was invested in something called the South Sea Company, the hottest stock in England at the time. He saw the market getting out of hand, made the right call, sold his position, and walked away with a profit of $7,000. A 100% return. Smart move. But then something happened. He watched everyone around him keep making money. Friends, colleagues, people less intelligent than him, all of them getting richer by the week. And he felt it. That pull. That pressure. There's a feeling every serious investor knows, but almost nobody admits to. FOMO, fear of missing out. The fear of watching everyone else win while you're sitting on the sidelines. It doesn't care how smart you are. It doesn't care how much you know. It gets everyone eventually. It got Newton. He went back in. At the peak. He reinvested everything. And then some. And when the South Sea bubble collapsed, he lost $20,000. In today's money, that's roughly $3 million. Gone. Afterward, he reportedly said, "I can calculate the motions of the stars, but not the madness of men." Here's the question I want you to sit with. If the most intelligent man of his generation, a man who literally invented the math we use to understand the universe, couldn't protect himself from market euphoria, what makes you think you're immune? The answer is, you're not. Neither am I. And that's exactly why this conversation matters. So what exactly is this indicator? And why does it matter? Here's the simplest way to think about it. Imagine you walk into a store. The store makes $500,000 in revenue every year, solid, consistent, real money. Now someone offers to sell you that store for $500,000. That's a fair deal. The price matches what the business actually produces. Now imagine the same store, same revenue, same products, same customers. But suddenly someone is asking $2.5 million for it. Nothing changed about the business, but the asking price is 5 times higher. That's when you stop and ask, is this price connected to reality? Or is someone just hoping I'll pay whatever they want? That's exactly what the Buffett indicator measures. But instead of one store, it measures the entire US stock market against the entire US economy. The formula is simple. Total value of all publicly traded stocks divided by GDP, the total economic output of the country. The result tells you how expensive the market is relative to the real economy behind it. Warren Buffett himself called it, and I'm quoting, "probably the best single measure of where valuations stand at any given moment." Here's the scale. At 70 to 80%, the market is cheap. Good time to buy. At 100%, the market is fairly valued. Price matches the economy. At 200% and above, Buffett said investors are playing with fire. The price has disconnected from reality. We are currently sitting at 236%. And here's the critical thing to understand. A high reading doesn't mean the market crashes tomorrow. In 2017, this indicator was already flashing warning signs. and the market kept climbing for 3 more years. What it means is that the risk is elevated. The margin for error is smaller, and the consequences of getting it wrong are bigger. That's what 236% actually means. Now let's put 236% in historical context, because numbers without context are just noise. Pull up the chart of the Buffett indicator going back to 1970. For decades, the indicator mostly stayed between 40% and 100%. The economy and the market moved roughly together. Things made sense. Then the late 1990s happened. The dot-com bubble. Every company with .com in the name was worth a fortune, whether or not it had a single dollar of revenue. Investors poured money into technology stocks with no earnings, no products, sometimes no real business plan. The Buffett indicator climbed to around 145% before the crash. The Nasdaq fell from 5,000 to 1,100. That's a 78% drop, and it took 15 years to fully recover. Then 2007 happened. The housing crisis. Mortgages were being handed out to people who couldn't afford them, bundled into financial products nobody understood, and sold around the world as safe investments. The indicator reached around 110% before everything collapsed. The S&P 500 lost over 50% of its value in 17 months. Two of the most destructive financial events in modern history. Buffett indicator peaks of 145% and 110%. Today, 236%. Think of it like a thermometer. Normal body temperature is 98.6 degrees. At 103, you're sick and you know it. At 107, that's a medical emergency. The Nasdaq bubble was 103. Today is 107, and nobody is sure exactly what happens next. But you don't ignore a reading like that. Here's what matters most. The indicator doesn't tell you when. It tells you how much risk you're carrying. And right now, you're carrying more risk than investors were carrying at any previous point in market history. That changes what you should be doing with your money. Here's where I want to be honest with you, because this isn't an alarmist video. The technology is real. AI is not a fantasy. The companies driving this market aren't making up their earnings. Nvidia, Apple, Microsoft, Amazon, Alphabet, these are businesses with real revenue, real profit, real products being used by hundreds of millions of people right now. Uber consumed its entire annual AI budget in just 4 months. Meta is launching paid subscription plans, in part because it's spending so much on AI infrastructure, it needs new revenue streams to cover the cost. These aren't companies chasing hype. They're racing to build the next decade of technology. And the profits are showing up in their quarterly reports. So this is not the dot-com bubble of 1999, where companies with zero revenue and a .com domain name were worth billions. The fundamentals exist here. But here's the problem. The gains are almost entirely concentrated in 5 companies. While Nvidia is up triple digits and Microsoft keeps hitting all-time highs, what's happening to Coca-Cola, to Nike, to Disney, to Walmart? Nobody is talking about those companies right now, because they're not the story. The story is AI, and everything that isn't AI is being ignored. When a handful of companies carry almost all the weight of the entire index, that's concentration risk. And concentration risk means that if those few companies stumble, even slightly, the whole index feels it hard. Think of it like an NFL team where one quarterback is carrying the entire offense. Tom Brady-era Patriots. When Brady was healthy, they won. The moment he went down, the whole system collapsed. You can't build a championship roster around one player and call it a strategy. And here's something else nobody is discussing. In euphoria, every piece of news becomes positive. A company posts decent earnings, stock up 10%. A CEO gives a vague statement about AI investment, stock up 8%. When the mood is good, the math doesn't matter. Everything goes up. The opposite is equally true. When sentiment flips, every piece of news becomes negative, and the same stocks that looked unstoppable suddenly look expensive and fragile. That's not analysis. That's psychology. And psychology moves markets more than fundamentals do in the short term. Here's how you know when a market has moved from optimism into euphoria. When people start investing at any price, without asking what something is actually worth. There's a company right now preparing for what could be the largest IPO in American history. The valuation being discussed is somewhere around $1 trillion. The company makes real things: autonomous vehicles, satellite internet, rockets, legitimate technology, real engineering. But the same CEO is also promising to build a colony of 1 million people on Mars. Self-driving cars, that's real. Internet from space, that's real. 1 million people on Mars, that's a different conversation. And yet people want in at any price, any valuation, without asking whether the math makes any sense. That's not investing. That's the same energy that filled the South Sea Company in 1720. Nobody wanted to miss out. Nobody wanted to ask hard questions. The music was playing and everyone wanted to dance. Now, and this is important, I'm not saying the technology fails. I'm saying the price being paid for the promise might not match the reality of the timeline. Look at the railroad boom of the 19th century. Railroads were absolutely real. They transformed America. They built the modern economy. But there was also a massive railroad bubble. Companies were wildly overvalued. Speculation ran out of control. And when the correction came, it was brutal. The technology survived. Many of the investors didn't. The same pattern repeated with the dot-com era. The internet was real. E-commerce was real. But the prices being paid in 1999 were disconnected from any reasonable timeline for those businesses to actually generate returns. The technology survived. The Nasdaq lost 78% of its value. Think of it like a rubber band being stretched. The further you pull it, the more tension builds. It doesn't snap at a predictable point, but the further it goes, the more certain it becomes that at some point it will. The market right now is a rubber band that has been stretching for years. Nobody knows exactly when, but the tension is real. This doesn't mean sell everything and hide. It means understand what's happening, so when the moment comes, you're ready. So here's what you actually do about all of this. My only concern with everything I've shown you today is one thing. I don't want you to become Newton. If the smartest man of his generation lost everything to market euphoria, you and I are not immune. The question is what we do about it before the moment arrives. 7 practical steps. Let's go. Step 1. Don't let euphoria make your decisions. When everything feels like it can only go up, that's exactly when you slow down. Not because a crash is guaranteed, but because the decisions made at the peak of excitement are almost always the worst ones. The market is designed to make you feel like you're missing out right at the moment you should be most careful. Step 2. Don't buy just because everyone else is buying. If you can't explain what a company actually does, how it makes money, who its customers are, what happens to it if AI growth slows down, you have no business buying it. Not a recommendation, just a rule. No promise without fundamentals. No hype without numbers you understand. Step 3. Keep cash ready. The stackers know this. Having 10, 15, maybe 20% of your portfolio in cash right now isn't weakness. It's preparation. When the market drops 15 or 20%, and at some point that cash becomes your weapon. You're not sitting on the sidelines. You're loading up to buy great companies at prices nobody is offering today. Some of the best wealth I've ever built came from moments of panic, when everyone was selling and I had cash ready to buy. That's not a recommendation. That's how this game actually works. Step 4. Diversify, and not just within tech. If your portfolio right now is mostly Nvidia, Microsoft, and a few other AI names, that's not diversification. That's concentration with extra steps. The companies nobody is talking about: Coca-Cola, Nike, Walmart, Costco. They're still generating cash, still paying dividends, still running real businesses. A correction that hits tech hard doesn't necessarily hit them the same way. Step 5. Avoid leverage. Borrowed money amplifies everything, gains and losses equally. In a normal market, leverage is a tool. In a market at all-time highs with an indicator at 236%, leverage is gasoline near an open flame. This is not the moment to be borrowing to invest. Step 6. Think long-term and plan for turbulence. At some point there will be a correction, maybe 10%, maybe 30%, maybe more. If you know that going in, if you've already decided what you'll do when it happens, you won't panic when it arrives. The plan protects you from yourself. Write it down before the moment comes. Step 7. Survive and keep going. You cannot build wealth in a game you quit. The investors who come out ahead aren't the ones who called the top perfectly. They're the ones who were still in the game 10 years later, still investing, still learning, still compounding. The goal isn't to predict what happens next. The goal is to still be here after it. Here's the summary of everything we covered today. The technology is real. AI is not going away. The companies leading this race are generating real profits and building real things. But the price the market is paying for all of it, 236% on the Buffett indicator, nearly double the peak of the dot-com bubble, has moved into territory that demands respect. Not panic. Respect. Newton was smarter than all of us combined. And FOMO, the fear of missing out, destroyed him anyway. The same force is active in this market right now. The music is playing.